Being able to identify traps within the game of trading is perhaps one of the most important skills to not only keep your head straight during situations like we had in the last 24 hours, and also perhaps generating some of the best opportunities and able to trade with some of the best accounts. With that said, welcome back to EllioTrades channel. I'm your host Krown again today with some good old TA. In fact, today a little bit more on the theoretical side. I just want to address the situation in the past 24 hours with that lovely move that is doing oh so well right now. Now, we identified this in real time on my own channel this morning as very likely a trap, and I want this video to be relatable over time, more importantly, so that we can go over what constitutes a trap, how these things get engineered, and then what happens typically after. With that said, I should let you know that, of course, I do have my own channel. There is a link in the description below. I do daily analysis on Bitcoin, and sometimes in a live stream format, and it's a little bit more in-depth and whatnot, which may or may not be relevant to you. If it is, you're more than welcome to hang out. If not, all good. Anyways, let's talk about the topic at hand, and this is traps. So first off, why do traps happen? Trading traps, essentially, which in this case, just for what we're talking about, is yesterday's move right here, where Bitcoin essentially made an ever so slightly new all-time high and then slammed it back down, taking out, well, a lot of people's stops, and then resuming right back in the middle of the range. So why does this happen? It's actually a very logical reason. So trading is a game of liquidity, especially in Bitcoin land, but this applies to pretty much all markets. What does that mean? What does a game of liquidity mean? Well, the people who actually move this market, they will they will essentially have to engineer liquidity for themselves, because you can't just go and market buy or market sell an exorbitant amount of the underlying, in this case, Bitcoin. So I'll give you this example right here. Put yourself in the shoes of someone with a massive account. I'm talking about $1 billion plus. If you were to go on, let's say, I don't know, whatever your favorite exchange is, maybe Bybit or whatever, and you go on there and you say, I'm just gonna market buy 10 million contracts of Bitcoin. What do you think is gonna happen? Well, if you do that, if you actually go look at the order book, you'll notice that if you buy 10 million, for example, or even more than that, or in some cases even less than that, you are going to move the market quite a fair bit. And this is not going to be great for you. It's not going to be great for you because whilst you might be at current price thinking that you're going to get filled at 65,239, what you'll likely get filled at is probably more like 66,500, for example. Now, I don't have the Bybit order books open in front of my eyes for right now, but I imagine that if you can just look at the total that is bid or offered at a certain price and then go deeper into the books, you can figure that out very easily. Yes, there are hidden orders. Yes, there are iceberg orders, but it gives you an idea of what sort of slippage you can occur, is what that concept is essentially called. Okay, so let me just get back onto my notes over here. Yes, that is why big accounts need to generate liquidity for themselves. Keep in mind that this is, it's a maturing market now, and there are a lot of big institutions involved, and these people essentially have access to unlimited money. So when they want to get their fills, it becomes very difficult to do that in the way that very likely you and I do it. What they have to do is they have to essentially create traps that generate liquidity for them. So how does this work? All right, we have multiple things going on here, and this is actually a phenomenal example of what we saw in the last day, and you can see that it was done on volume 2, so there's a lot of liquidity generated. All right, so what's happening here? Well, it is no secret that this market is severely over-leveraged, and and not just over-leveraged, but a little bit exuberant as well on both sides. So when you have a situation like this, where you are, in this case, actually making new all-time highs, essentially, well, what are you potentially at the mercy for? You're potentially at the mercy for alluring a lot of breakout traders into some very, very nasty and exposed positions. So in this case, what happens yesterday? 2 days prior, technical term right here on the 9th of November was a doji candlestick. And a doji typically indicates indecision or reversal. And so the way that a lot of breakout traders will play this is that if you take out the high or the low of it, you will then see that move essentially, well, extrapolate in that direction. So in this case, breakout traders are looking at any sort of a move above the 9th of November's high as, oh, we have continuation, market buy, all good. And for a brief moment, they were right. However, the market movers had a different idea. They know that a lot of people are thinking that way. And by the way, this is why I do not breakout trade, especially, doing it on market as well. Ridiculous, doesn't need to be done. But anyways, what happens right here? For a brief moment, they are successful and they're like, oh my God, we did it. This is great. This is amazing. What do the market movers do after that? They know that if you market buy this potential breakout right here, especially on leverage, you are going to have a major pain point, and you're going to also have what's called either a stop loss or a liquidation point, both of which mean that you are forced out of your position, forced to essentially sell. Sell to who? Well, who is ever buying on the other side? And who is buying on the other side? Very likely some bids from some big accounts. And so they know that they're going to have stop losses somewhere right around here, just below $67,000. Okay, but that's not all. We can run it the other way too. We can run it the other way too. And what happens after that? Well, it is a doji, right? So we come back down below and, well, now we have the breakdown traders, essentially the guys looking for a market short, who are going to get excited about this. And, well, they are right for a while. And not only that, but we then bring it into the major area. So remember when we identified this ascending triangle, just a reaccumulation base right here between this rising bottoms from the 28th of October to our resolution over here and 8th of November. Well, there's a very specific reason why things came back down below this region. A lot of the people who bought the breakout over here, which was, legitimate one, they know that if they were playing this formation, they're very likely going to have resting stops right below the resolution point of that formation. This is why, in my opinion, if you are going to use stop markets, which I do think is wise, it is not wise to just have them resting right where everyone else probably has them resting. You want to do it below. In this case, at least in my opinion, this would be a lot of risk. So maybe it's not relevant to you, or maybe it is below the last higher low in this case, just as an aside. Anyways, once it comes back down below here, you not just collect the stop losses of the people who longed from the 8th of November breakout, but now you have a bunch of shorts being added onto that, thinking that this is going to be the breakdown. We're going back down to, I don't know, 0 or whatever. And so they get overly excited as well. And now we can trap some shorts on that side. All the while, who's getting the fills? The big accounts, and they just have these resting orders and they're filling it up, as well, basically as fast as they can. Anyways, okay, so how can you avoid this? How can you essentially identify this? Well, first and foremost, this is why I do not suggest breakout trading in this case. When you see something like this over here, you should be on guard. And what you really want to see, and the best defense against this, in my experience, is waiting for closures if you are going to be a breakout trader. Now, in the case of the people who bought over here, like I said, you don't want to have your stop loss at the breakout point. If you're playing the trend, which is what pretty much all formations boil down to, you have to play the trend. And the trend is still your friend right here, actually. But the problem is, if you're playing the trend, where should your stop loss be? At the last higher low. That's what you were essentially buying. And where's our last higher low? Not anywhere near this area right here at 64,000. It is actually all the way over here at 61,000. So if you did have a stop loss over here, you'd still be in your position. You'd still be right. Now, I would argue that none of this is optimal right here because, it's probably better to be on lower term timeframes and trading the ranges. But hey, that's my personal style. That may or may not be relevant to you. Also, if you're just looking at this from a major moving average perspective, both waiting for closures, of which we got no closures below even the shallowest of the moving average periods right here. Didn't even come down to the 21, in fact, as well. So in my experience, that would not have constituted a closed position. So it's very common that retailers have their stop losses around these regions or their pain points from, over leveraged trades. Of course, this move just in general was about 9% move right there. So even people on theoretically lower leverage were getting liquidated off this. And again, liquidation is exactly as it sounds. You are forced to let go of your position. And when you're forced to sell, or in case of a short buy, who are you giving it towards? Well, the resting bids and offers on the other side. Okay, cool. What's another way that we could go through and essentially judge when these traps are likely to happen, or that it even is going to be a trap to begin with? Well, this is sort of the next evolution of this video. So this will be a little bit, we'll have to go a few more minutes here. Anyways, first and foremost, like I said, if you're going to play this sort of formation right here, which is very much active still, well, what happens? You either have to wait for a closure below this level right here, the breakout area, or a wick lower than your prior daily higher low. So that is how you can avoid them. It's by being more patient. Now, there is a trade-off here, a very important trade-off to make, and it is this. If you're going to be a more confirmation or conservative trader, which I certainly consider myself, you're going to have a trade-off between potential profits and more higher quality or efficacious entries and positions. So that's to say that you're not going to get as many signals, and more importantly, the signals that you do get, you'll obviously be entering in or exiting a little bit later. However, it does allow you to stay in these positions if that is your goal. Now, with that said, how would I judge if this is actually going to fall apart and not be a bear trap, but indeed be a bull trap and come down further? In this case, probably somewhere down around 58 to 59,000 bucks. That would be, again, as we said, either a closing wick low than our current low, or a daily closure below our current base of this formation. By the way, just as one more aside, because I do want to be very direct about this formation right here, this ascending triangle, we did hit the measure move off of this. And when you see something like that, you do need to take profits. If you're playing that position, that is the technical target. And we went over this, I believe, a week ago in preparation for this breakout. So it's not always going to look like this, but you can expect pullbacks after a target like that is met. I believe it was also a major fib as well, which I will just pull up really quickly right here. And what do you know? It's right at the 1.618, a very common pullback place. A lot of the time, you will see liquidity hunts in these regions. The liquidity hunt just above was a success, and then gets brought back on lower, and same thing there. Okay, there's one last thing that I want to address here. This one's a little bit more nuanced, but in this particular situation, I am leaning towards this being a bear trap, meaning that Bitcoin very likely puts in another higher low right here, above $64,000. And essentially, as long as Bitcoin is closing above $64,000 on a daily closing basis, I am looking at this as very likely to trade sideways and up from this region. So how else am I getting this? Not just from what we spoke about earlier. I'm also getting it from this area over here. Essentially flow analysis. So what I have going on right now is I'm looking at the last trading period here, and I'm looking at what's called CVD, which is cumulative volume delta. It essentially lets you know which side of the market is being more aggressive by using market buys or sells. A positive number reflects that obviously there was a net market buy, and a negative number reflects that there is a net market sell. And what positions are we most concerned with? Leveraged position. And what is that represented by here on the charts? The perps, of course. Again, those are the ones that can be liquidated. And what do we see? Well, we see a net market sell of 51.17 billion with a B. On the contrary, Coinbase and Bitfinex, my two favorite spot exchanges for judging direction, are both net market buys. That's typically where those big market movers actually do operate from, just for what it's worth. And those are spot. So that does mean quite a lot in my opinion. And you can see some of the big buys coming in through here. Another $1 million done on Binance. Anyways, we can deduce from this that shorts are being a lot more aggressive in this last 6-hour period, which does imply that a lot of shorts have been adding below, especially this $65,000 area right here. Already, the majority of those short positions are well underwater. Well, I wouldn't say well underwater, but they are underwater. These guys, especially over here, who sold below 64, those guys are good luck. Good luck. Not saying that can't work out for you, but certainly against you right now. Anyways, What does this always, always, always boil down to? Trend. Trend, 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 trend. If there's one thing you ever get from me ever, trend, please. It is the most important thing in my experience. The longer that I go within this whole endeavor, the more and more that I come back full circle to, okay, this always boils down to trend. Anyways, what do we have right here on all time frames, even down to a 4 hour? We have an uptrend. And this very likely is shaping up to be the next higher low. Again, not because it's 100% guaranteed, because there's a nice edge right there and a verifiable way to invalidate this as a higher low, which would be below $64,000. In that case, well, I'd be looking for another run at about 62 to be fair, and come back after that. Until then, all medium and higher and macro timeframes are still within very much an uptrend. And that is how you can avoid these sort of things, because you can identify quickly what the trend is. And if the trend is not destroyed, even whilst having one of these more nasty setups, which actually, sorry, we should go back to the daily right here, then it's most likely to be a trap. And as long as those levels do hold, well, that's where an edge can be found in the market. Anyways, I'm going to sign off with that. I want to wish you well in this video, because this is something that you're going to very likely, if you do continue on with your trading journey, experience many a time, especially in Bitcoin land. And it can be very, very powerful to understand, obviously. So use it well, study it, and I'm sure it won't be too long before we see the next one. That said, take care. I'll see you soon.